Well, traders, it's Wednesday, May the 29th. This is John Kickleiter, Chief Strategist for DailyFX.com, here to give you a market wrap up for the past 48 hours of trade. And more importantly, an outlook for what we can expect in the next 24 to 48 ahead of us. Well, we're coming off of a long holiday weekend for the US and UK, two very significant sources of liquidity on the speculative side, and it's frankly very difficult to actually establish any kind of significant foothold with volatility in those kind of conditions. Now, you can compensate when only one capital for the financial markets is offline sometimes, but not with two. And given the fact that the markets had checked higher as of Friday to prevent a critical breakdown on the likes of, let's say, the S&P 500, which you can see here, we were left with a something of a further diffused explosive. But there is still very much risk associated to the patterns that you're seeing on the charts, but also the numerous fundamental issues that we continue to plod through. Now, those fundamental issues did not go away over the holiday weekend. They are just as prominent as they've ever been, but they've also cleared a few headlines, or sorry, deadlines. So we don't necessarily have a milestone in the immediate future. We can say that this is the pivotal time for an explosion, I don't know, in trade wars or a escalation in political tension or what have you. So it is a little bit more of a wait and see, watch the mood of the market through the benchmarks for sentiment, whether it be the S&P 500, the Dow, or if your preference is to look rest of world or other alternative assets like emerging markets, but keeping tabs on the weather that you see in price action, as well as keeping a wary eye on the headlines should any of the unforeseen developments on these themes suddenly erupt. Now, those themes continue to be that we've been following for the past weeks and months continue to be exceedingly important and on knife's edge in many instances for corrupting the unreasonable confidence that seems to just keep pushing forward, plowing ahead in speculative terms, regardless of what the threats or the risks happen to be. Now, that's not going to last forever. There's inevitably going to be either a positive turn in the big picture financial markets and economy, or sentiment is going to start to confer more closely to value, and it will correct one way or the other. And I have to say, economic condition and financial value takes a lot longer to build up than sentiment does to tear down. So consider that when you're evaluating your own exposure, your own risk. In terms of the themes that we keep tabs of, and we will continue to keep tabs of, trade wars is definitely front and center to start this new week in earnest. The significant escalations have certainly paused. We have not seen the addition of any new tariffs or increase in the tax rate for imported goods between these two countries, the United States and China. But the mood is certainly very dour, and there is a loose, kind of open-ended deadline on expanding the United States tariff blanket on Chinese goods from, I guess, quote unquote, just $200 billion worth of products to encompass its entire import, which is north of 500 billion, which would be an enormous escalation. But there is no clearly defined timetable for when that decision is going to be made. They said when they up the existing tariff list to 25%, that'd be 2 to 3 weeks. Obviously, that might be pushed back. It was left ambiguous, probably for a reason, as the two leaders, Presidents Xi and Trump, are not due to meet until the end of June, sometime around the G20 summit. So theoretically, they could expand the tariffs, escalate. China would retaliate, most likely taking a more extreme route because they're running out of the traditional solutions. and subsequently creating a lot of problem and a lot of tension for which it would be that much more difficult to negotiate through when the two leaders met and officially. Now, normally I would say that that is a very improbable situation, considering all the added weight that it brings. But these are not normal times, and the administrations are proving willing to take it to the next step. So keeping tabs on China and not definitely not resting on our laurels. You can see actually the USD CNH, the dollar yuan. We had a advance from the USD CNH, and that is somewhat unusual because we've had actually a consecutive series of declines until just recently. So now we have after what, a 6-day consecutive decline, the longest stretch, matching long stretch since November 2017. We have a bounce higher back towards that ever present 7 yuan to the dollar mark. Remember, if we reach that level, much less if we breach it, it is going to signify something very severe, either intent on the Chinese side to escalate pressure or tension, or the Chinese authorities losing control. I don't know which one would be worse. Now, there is still restraint that you measure here, as there is also restraint in the Shanghai Composite. But we need to register the exchange rate and the performance of the capital markets against less massaged figures. So, for example, comparing the USD CNH to the USD HKD, the Hong Kong dollar, this actually has a hard cap on a fixed rate. There's a fixed rate with a tolerance band. The upper bound of that tolerance band is 7.85. We keep hitting our head on that upper tolerance band. Clearly, something is amiss, and the capital outflows from mainland China through this financial hub into the rest of the global market. And then comparing the Shanghai Composite to the FXI, the US traded ETF for the Chinese market. Normally a very highly correlated performance between these two, but if you compare the Shanghai Composite's recent stabilization to the FXI, you can see they're starting to deviate a little bit more readily again, which is probably indicative of Chinese controls not making it all the way to the broad markets. Now, what is going on beyond just price action? Recently the rhetoric was heated up over the weekend. President Trump suggested he's not ready to make a deal with China. No surprise there, but to reinforce it only essentially draws attention to the glaring wound. As well as in China, the state-supported Xinhua produced a story that suggests America's demands were essentially against China's core interests, which is an essential way of saying they will not be budging on those views. Uh, there's a lot of talk now about what next steps can be to escalation. China is reportedly investigating how it can utilize its exposure to the U.S. Equity markets to create pressure. Obviously, there's a lot of talk of their possibly selling U.S. Treasuries, which actually shoot yields higher. Clearly, that is not of great concern because obviously yields are dropping here. But that option is unlikely to be pursued. Most likely, for the principal reason that they're one of the largest holders in the world, you wouldn't want to blow up your own holdings. You also have to keep a very healthy balance for all the dollar exposure that you end up having given the trade. But Chinese selling shares in the United States could also be something that they could pursue. There are greater controls in local equity markets and considerable capital restrictions for cross-border speculative flight. So causing some instability in the U.S. equity markets is potentially an outlet they can pursue. Always going to have kickback, however, or blowback from any troubled efforts like that. There's also the suggestion of perhaps kind of doing to Apple what the United States had did to Huawei, though that is also a very messy pursuit. In the meantime, we learned over I think the previous trading day, Monday, that China had done its first bank seizure in 20 years, a company that was reportedly at credit risk with some 60 billion yuan in exposure to risky bonds. So that was of general concern. We also had the economic data from industrial production or industrial profits, sorry, which did drop unexpectedly 3.7%. The previous month saw 13.9% growth. So not encouraging in the least, and continued evidence of trade war influence. Now, outside, not all trade wars are negative. Well, all trade wars are negative. Just the the contraction expansion of their trajectory is a little bit different. For example, in the U.S. MCA situation, U.S. Mexico Canada, the replacement of NAFTA deal, which the United States removing its steel and aluminum tariffs on the U.S. and Mexico has subsequently engendered some confidence from the Trudeau administration in Canada. They reported that they would be looking to ratify that NAFTA replacement, which is an encouraging development, but it's probably not going to be the key catalyst for the USD Canadian dollar exchange rate. For that, we'll talk about in a second. Now, outside trade wars, politics were obviously enormous over the weekend. We had the EU parliamentary election, and as expected, the populist nationalist interests had taken very considerable foothold. They didn't gain nearly as much advancement as many had expected, hoped slash feared, but there was a significant movement away from the moderate-leaning conservative and liberal party sides, which means that there is a further divergence to the more extremes, which is not a encouraging sign for significant progress and for finding compromise and solution to things in Europe that are already difficult to achieve. This is not unique to the EU or the European continent. We know that this is something that's being seen everywhere, but it does create greater problems. And the euro doesn't need any additional issues. It has plenty of its own. So adding this unstable political backdrop is certainly a problem for the euro. It's also a problem for cooperation globally. When we look at the performance of the capital markets and the trajectory that we find the entire global economy on. This is the ACWI All World Equity ETF, and it certainly does reflect nicely these uncertainties that we continue to deal with going forward. Now, another more prosaic concern, growth, as important as it is, it's definitely getting downgraded. We had a number of warnings issued for the health of the auto manufacturing around the world. This is cars, it's an ETF for the US autos, but the auto manufacturing or autos themselves is a very sensitive industry for trade wars. It's also very sensitive for consumption because it is a large financial purchase item. And there are a number of warnings that are going out about the health of this industry. One of them was actually from Fitch, the rating agency, who said the slowdown in global auto markets has had a material impact on manufacturing and ultimately GDP. Now, if you want to get away from the more specifics, and really these are the connecting themes between things like trade wars and GDP, but if you want to look at something a little bit more broad, the indicators, the measures of pain. How about the 3-month, actually, sorry, the US 10-year 3-month yield spread? This is the economists or the wonks' favorite recession indicator. And as you can see, we hit a new low. We overtook or undershot the March swing low in this yield differential, now about 8.6 basis points below break even or inverted and with inversion. If you pump it up to a monthly chart, you can see we just pushing it to levels we haven't seen since 2007. Notably back when we actually had a recession, which is the red box when the actual recessions occurred. I said it before, just as a recap, I don't think this is a perfect indicator, especially after a decade worth of quantitative easing and intent to kind of pull back from that exposure from the central banks. But it doesn't necessarily have to be a high causation. It can also have correlation for a number of collaborative reasons. And I think there is a fairly strong risk of a U.S. and possibly global slowdown, if not full recession. So, a troubling sign, a very troubling sign. Now, back in the capital markets, looking outside of the wonky stuff, the risk benchmarks continue to form just overtly tense patterns. Uh, Nowhere is that more obvious than what you get from the likes of the S&P 500 or the Dow Jones Industrial Average, which, as you can see, both are very clear head and shoulders patterns. In fact, I said this in Twitter, but the Dow could, I mean, you could put this into a textbook. It is a perfect textbook setup for a head and shoulders pattern reversal. It has all the elements. Of course, you have the traditional and the infamous head and shoulders pattern, the high, higher low, and lower low. You have the neckline, which can be flat or it can have more of a pitch to it, edging higher or lower. But what is most important, what I find too many people leave out, is the period leading into that consolidation, that congestion pattern. You had an enormous rally through the opening 2 months of the year. All right, this first phase is a huge move to the upside. It was largely a reversal of what we had from the intense sell-off in the fourth quarter, but this is nevertheless a big run-up. And what's important is this is a consolidation, possible potential reversal pattern. You need something to reverse. The more intense it was, the bigger it was, the more prominent the capacity for that turn is. And that does qualify quite clearly. So I'll be watching this fairly closely. Of course, just because you have a technical pattern does not mean that it has to break. I'll put to you the S&P 500 again. You had this rising wedge, a break of necessity, and it decided to clear to the top side, a positive bullish break to record highs. Immediately lost all drive of follow through that double top break. Why? Well, because of the capacity of the markets to forge a strong risk positive lean when the conditions are already stretched was really improbable. But the markets just generally didn't have the capacity to mount a clear true rally. And the same might not be true or might be true of the opposite direction. Just because you have a technical break does not necessarily mean the market will run with this. So don't presume that this staging is going to lead to easy, clear trades or even indicative of a shift in sentiment. That might not be the case. I've seen far too many of these buildups, these setups, falter upon launch in the recent past. So just eye this with caution, but definitely do not take your eyes away from what the potential may be. It could certainly turn into a more productive, more catastrophic reversal if it taps into a deeper fear in the markets. Now, as of other risk assets, I do think that there is certainly a capacity for a necessary break, a break of necessity versus a break of necessarily intent. You can see that in, for example, the German equity index, the DAX. Obviously, you're leading into something of a break there with a wedge within a larger rising trend channel. You can claim the same thing of a wedge potential break for the FTSE 100 or the French CAC 40. All right, that's definitely a wedge with a possible break. Also qualifies as a head and shoulders pattern. You have the Shanghai Composite, which is a little bit, as we talked about, a little bit questionable, but it's working its way into a possible break, though follow through is probably going to be significantly limited here because of the capacity of the Chinese authorities to control it. But Nikkei 25, similar wedge with a little bit more movement, a little wiggle room where it has to be forced into a situation. The emerging markets, the junk bonds, uh, they definitely have a need for a break. As for the commodities market, and I use the commodities as well as the global government bond yields, these are more of the growth associated risk assets. So they certainly do reflect upon risk appetite trends, but they also are very much directed or steered by economic potential. And as you can see, they're not necessarily staging that buoyant and loosely held enthusiasm. In fact, for yields, you are dropping and dropping quite concerningly in an aggressive fashion. You compare this to something like the S&P 500, which is pure risk, and the deviation, as I've said, and I will continue to say this, is of considerable concern. It's possible that yields can completely reverse course if central banks, let's say, suddenly take a tightening turn. I find that very unlikely. More likely, you will see that equities, particularly U.S. equities, will rush to meet their yield counterparts. So keeping our tab on these risk measures, because they're, trading is actually done in the price action and the charts, but it is also a very timely indicator of mood, of what matters for sentiment. Now, in terms of the regional considerations, if risk trends started to develop or trade wars started to take off, where is the market going to move? The dollar continues to maintain its buoyancy. It's interesting considering it hasn't catered to its safe haven role. So this is FX volatility. Obviously, fear is not rising here, nor is it supported by its interest rate forecast. In fact, implied yields to the end of the year through Fed funds futures have dropped to their lowest level now, a fresh new low, since back in late 2017. So there is not much to give this the traditional lift, but nevertheless, the dollar continues to outperform, as you can see here in this trade-weighted dollar index. This is most likely a reflection of the currency taking advantage of its major troubled counterparts. And the reason it would do so is because of sheer liquidity. We've talked about it before, but when the markets are looking for somewhere to find safe harbor, and it's the euro, this is the percentage of use of currencies and reserves, when the euro, this currency, the pound and the yen, these two currencies down here, are all under pressure cumulatively, where does capital move? The only thing that's more liquid than all of them, the dollar. Okay, so it's taking advantage of this status, and it needs it because it doesn't have the traditional backing from these fundamental motivators. In terms of data, we did have a consumer confidence figure that again impressed, like the University of Michigan Consumer Confidence. While the U of M had some caveats beyond the headline figure, the same is true here. The Conference Board figure for May did jump from 129.2 to 134.1. This was similarly not fully encompassing the mood change that came with the deterioration in U.S.-China trade relations, but it nevertheless stands as a possible positive. In the meantime, housing activity in the United States continues to show some fissures, some cracks, and that is just being overlooked for now because it's not as important, it seems, to the market's general focus. Now, in terms of what comes up, Wednesday is light for US based event risk, and we do have trade war implications and details of GDP activity in the United States on Thursday. But even then, I don't think it's going to carry a strong capacity to motivate the dollar. I think we're going to find a lot of what motivates the dollar is coming from outside influences, so euro, pound, yen. Speaking of the euro, it had some of the heaviest fundamental waves over the past 72 hours. In terms of the traditional data, we had a German consumer confidence report, came across wires weaker than expected, 10.1. In the meantime, the Eurozone economic sentiment indicator actually advanced, although business and consumer was still struggling. I'm watching these sentiment surveys. I think they're great indications of how things that are initially abstract, like trade wars, are filtering down into the markets because the tariffs that will arise from the trade-off between the U.S. and the EU, for example, is still metals tariffs in place, and the threats of doing more, like the auto tariffs, uh, they will take time before we start registering in official data, but you will see it in sentiment, and that changes people's intent for investment, for consumption, for savings, and that can turn into immediate impact on GDP. So I'm going to keep watching this. But in the euro area, there were two themes that were a little bit more important. Obviously, the EU parliamentary elections, as I said, they ended with more populist showing, but you would also see a more fixed interest and uncertainty around Italy. Italy has been an on again, off again ulcer for the stability of the euro. This is an equally weighted euro index, and you can see it is not moving from this really tight range. This is definitely a break of necessity, uh, and I think that it's more likely going to trigger intent. The issues with Italy, it was Deputy Prime Minister Salvini who warned that the EU may slap a 3 billion, up to a 3 billion euro fine on the country for its missing or flouting the budget limitations, the budget rules. We actually saw the let's see, the 10-year Italian to German yield spread jump on the day with this news. This is in fact one of the biggest jumps in the opening performance. Let's see, there it is. One of the biggest opening gaps higher in this yield spread since 12 months ago. All right, it was the biggest jump in 12 months. It goes all the way back here to May the 29th. So perfect timing. This is certainly a point of worry because, as I've said, if the euro truly comes under pressure of stability for the euro area, the glue that holds the financial and economic backing to that shared currency starts to melt and break away, confidence in the euro is going to disintegrate, and you're going to start seeing more capital flee the euro, finding its reserve interest in dollar, pound, yen. All right, so keeping that in mind, obviously there are other complications when it comes to something like the euro pound, but where you see the euro is performing well. This is not a very long list of pairs, but where it seems to be doing better than counterparts, definitely a reason to look a little bit more closely at performance. Uh, there are a number of other things, like a suggestion that the Italians are going to be pushing for ECB guaranteeing government debt. That's a little more abstract and not going to gain traction now. Standard & Poor's rating agency suggesting European banks were well capitalized but will struggle for profit going forward. Also a concern, but not immediately market moving. I'd watch the Italian-German 10-year yield spread to get a little bit more guidance for when things can get a little bit more explosive in price action. If you were looking for a concentrated dose of fundamental impact, definitely keep a close eye on the Canadian dollar. Now, the interesting thing about the dollar CAD, the benchmark Canadian dollar cross, is the 20-day range on this, so the equivalent of one trading month, is in essence at an extreme low. All right, its range over these past 20 trading days is the smallest that we've seen since July 1997. All right, 2 decades. That is extraordinarily restricted. And you see the same thing in the likes of the ATR. You can ATR as a percentage of current spot price. It's as low as it's been since the summer of 2014. Before that, it's really unprecedented. The markets are very quiet and very uncertain about what's happening with the Canadian dollar. Obviously, the USMCA is a question. Correlation to oil is something that's always on traders' minds. But I would also put into that echelon of concern the impending Bank of Canada rate decision. All right. This is unlikely to usher in a change, but the Bank of Canada is coming off as one of the more hawkish major central banks when the weather was still fair for monetary policy. In fact, I think they really stand as the most hawkish central bank of the majors. So they still have ground to lose. That could be, in other words, a break to potentially the upside if they take a more dovish stance, certainly if they cut rates. But if they voice a more hawkish lean, it could also be a swing back to the downside, maybe eroding some of this gain that we've had over the past year. So keep this one in your list. I know it's dropped off of a lot of people's watch list because of the tight range. Reasonable. But when you reflect that this is an unusual range and unlikely to hold, it starts to generate a little bit more capacity for potential, trading potential. A couple other currencies that we do need to keep an eye on, but for which I'm not as confident in price action or the consistency of market movement. The Swiss franc, so the USD-CNH you can see here, Euro Swiss, a remarkable response to the otherwise positive Swiss GDP figures, which were better than expected, 0.4 to 0.6 percent GDP growth on the quarter. The year over year was 1.7. Previously, it was 1%. So that was actually encouraging, though the Swiss franc did not gain against its benchmark counterparts. Keep an eye on this. There is some interesting franc cross performance out there, and I think it's a better counterpoint rather than its own catalyst. I would also say watch the British pound. Obviously, Brexit is an enormous influence, but it is also, I think, in something of a stasis. And that's because Theresa May is essentially a lame duck. She's waiting for her time to step down on June the 7th. Parliament is in recess, but it should be said that her successor on the Conservative side is almost certainly going to be more aggressive towards a no deal outcome. In fact, one of the potential candidates for replacement, Esther McVey, suggested they must embrace a no deal if they are going to get to October the 31st and there's no compromise. We're going to hear a lot more of this, but will the market necessarily pay attention? That's what remains to be seen. We did see on the other side the EU said, well, through Juncker, that there would be no renegotiating Brexit through the previous withdrawal agreement bill. I would also watch the Australian dollar, and that's because, like the pound, it's had a very long, aggressive decline. And obviously, there's some strong trade war related influences here, just like the pound has strong Brexit relations. But that doesn't necessarily mean that you're going to continue to have that kind of pacing. And we've seen a lot of consolidation as of late. Even a short term retracement or rebalance is a probability if markets check to some stability and risk appetite. There aren't a lot of reasons for me to be confident that risk will end with a bounce to the upside, but it's good to have solutions if there is, just to take advantage of the market shift. Finally, in commodities, crude oil was more of a bounce and hold. We're kind of jostling between some technical levels, 60 and 57.50 to the downside. This is kind of a holding pattern just until the markets regain traction on growth forecasting and the uncertainties of relationships between the United States and Iran when it comes to production for major OPEC members. I thought a little bit more interesting was the performance of gold. Not gold by itself, that actually dropped thanks in part to the dollar, but gold as it relates to silver. The gold silver ratio, as you can see, it jumped to a new high. You can't really appreciate that high unless we go up to a monthly chart, and then you can see that we have actually pushed this ratio to the highest levels we've seen since March 1993. All right, that is extraordinarily high. What does this insinuate? Silver is a cheaper alternative to gold. When gold is a speculative desire, people will bid up silver as an exposure, a cheap proxy to the precious metal. But when people are looking for absolute safety, they more prefer the metal that is used in that capacity as a reserve in its own right, as an alternative traditional currency. So while gold might not be tracking higher because of the confusion in currencies that price it, this ratio does suggest sentiment is as unstable as many people are concerned for. Okay, we'll wrap it up here. We'll do our next rundown of these markets tomorrow. Until then, I wish you all good luck trading out there.